What's up, everybody? It is Sunday, January the 15th. The markets are closed tomorrow, so going to be a lot of button pushing FOMO addiction problems because there's no buttons to push. And what I got here on the screens for you is what I was showing as we were heading into last week on the weekend update and again on the Monday morning email, where my forecast was for SPX to be heading. That's what you have on the left here. And on the right, what you have is the results. We even printed 4,000. Not only did we print 4,000, but as I had said last week when we did the update for the January 6th trade of the week, which was plus 150%, I have another trade of the week coming out for this week, the week ending January 13th. Won't be as great, in my opinion, right now as what we had for that week, but I'm thinking that we'll be able to get out somewhere between 50 and 67%. 50 and 67%. That was what I was forecasting for. What did we get? We wound up getting between 25% and 67%, with the majority somewhere in the range between $1.50, 42%, and the $2 that many people were posting that they got into, which was a 67% trade. The trade of the week was to buy the January 13th SPX 4025 calls and to sell the January 13th SPX 420 calls. $5 spread, $4 to $3 at risk, anywhere from 25 to 67% on the return. On the posting, on how it was posted, this was the post here at the beginning of the week on Monday, looking for that 4020, 4025 for January 13th. It had currently been at 90 cents prior to the open. I was looking for around $1 as a minimum, no less than that. We traded it multiple times during the course of the week as you had that dip in the middle of the week, and then you had the CPI run. As you can see here up on the top, prior to the open on Monday, 7:57 in the morning, we were talking about getting the January 10th, selling the 39.45 calls and buying the 39.50 calls. They were currently trading at $1.30, which was around 35%. Had to wait until the open came out. Had to wait until we saw that we would go and run right to where my areas were, as we did on Monday, and that's exactly what we got up to. We got our dip on Tuesday, not as low as I was expecting, but bringing you back over to where we count and calculate everything. $3 credit was able to be get on that 39.40, 39.35. The 39.50, 39.45s as well were a little bit less for the same day. And as you can see there, the best trade was that 39.40, 39.35, 150%. 39.45, 39.50s were around $1, $1.25. So you just got a little bit more than 50% right around, because I did see it printing around $1.50, $1.75 at different times. Anyway, didn't get to take too many risk trades because the market kept running over us. Risk trades pay 90% of the time. Normally when you get a risk trade, it moves against you. You've got the ability that you can roll it to the next day. We had a little bit of a different situation with what took place this week, because as I count, for me, with what I do on my spreadsheet, counting and color coding every single day the SPX data, we closed green above the close, the prior day's close, 4 days in a row. Now, we had done that back in July, going into July 4th. We did it as well in September. We had 4 in a row in September when we went up to that 41.19, which is where the next day was CPI, and we completely sold off back there in September. We had 3 in a row in August, 2 in July. We had 3 in a row after we hit the bottom right over there in October. And we had 3 in a row off the November low when we were heading into December. You could technically call Monday quasi-green because we did close only down 3 points, but we still closed red, so it counts as red. We had that big day on Friday last week where all the bears got converted into being bulls, and this week it paid off as you had that 4,000 print. Now, you get a different count when you go on to different websites. And as you go over here onto the standard knee-jerk reaction stock charts, which is the default for most newbie traders. TradingView as well, but stock charts was for us guys who were using the internet when we still had dial-up. We still had 56.6, connections. You had 4 closes above the open. They count it differently what their data is. They look at the open, not the close. So we had 4 in a row, 4 in a row, 4 in a row, 4, 4, 4, 4, 4. And you see where we are in our spots. Every time that we had 4 in a row, you can see where we are. Now, some people might say that we're kind of looking like we're in March right now. I'm not going to agree. I'm not going to disagree. All I'm going to say is I have been able to throw out these trades regularly as we had that. Again, here we are going into the Monday morning email. All the data, what's coming up during the week. I'm in the March 17th and June 16th SPY 430 calls, showing you what we've got there, all your data, and here's your trade of the week. Same thing on the weekend update, posting what we've got here. This is my preferred view as we go into earnings. So where we are, we're making money. Your first trade, taking this trade of the week, prior week, 180, 150%. You're risking $2 to make 3. You got $200 at risk for a $300 return. This week, a little bit more. $4 to $3 risk, you're taking a $1 to $2 return. I have another trade of the week set up for January 20th. Not going to reveal it yet. Not even going to throw out what percentages are out there because what we've got here is a little bit of a problem. And when I say problem, I'm talking about a problem with being able to collect credit. The Dow got a problem here. We're right up here at this 34,180. Been up here many times before, and it's not really worked out well. So not going out there and throwing on any bearish hat. If you're a member of the chat room and you've been in the chat room with me since any time since October, you know what my position is. Looking over here at the NDX, the NASDAQ is your legs, and the NASDAQ did its run, and the NASDAQ 4-hour kind of got about as overbought as it's been since it was back over here in the October run where it had this little first bounce off of the dead cat after putting in the lows. Still greater than 30% from the all-time highs, still greater than 50% from the COVID lows. Got a little bit of a problem here. We'll see. Got a little bit of a gap, but got a little bit of a problem. Anyway, coming over here to the VIX, this is where our problem is with being able to collect credit as greatly as before because we have broken below the April lows. We have broken below the August lows. We have broken below the December lows, and we are now at new lows, pushing back to as early as January the 4th, which is when we posted the all-time highs on the S&P. So got a little bit of a problem here with the VIX being this low in being able to sustain the ability of collecting credit so easily and with such great percentage gain returns because we do have a very low VIX. With a low VIX, you have low pricing. Low pricing means better off playing on the calls and puts. Got a couple of positions set up for this week, heading into next week. This week, tiny earnings, got Netflix. Next week, big week. All the big names report, and then we head into the FOMC meeting the week after that. So I appreciate all of your support, your comments, your hatred, your love, and most importantly, just go outside and make somebody smile because that's what it's all about.